to you again. Good evening and welcome to Sunday night at Who Wants to Be a Millionaire.
Who wants to be a millionaire? I just played the old school intro with Regis Philbin from the first season of Who Wants to Be a Millionaire. And guess who wants to make us all millionaires, or most of us millionaires? The Federal Reserve Bank with the wealth effect. That is official Fed policy going back decades, since the Alan Greenspan Fed. I almost knocked my mic out there. I got so excited talking about this. But $1 million, unfortunately, my loyal listeners, $1 million does not buy what it used to buy. So the cost of living is up enormously. The people's living standards, are people really better off from 1, 2, 3 decades ago? Maybe there's some people that are better off. Maybe it's the hedge fund managers, the large banksters who are benefiting from the Cantillon effect, the corporate insiders, the people running large corporations who have been participating for the last 10 years or so in this share buyback scheme with artificially cheap debt. Meanwhile, many people with interest rates manipulated down are not able to retire. So retiring many years ago on millions of dollars, you could live off 5 or 6% returns and not have to spend your principal. Those days are gone. So the Federal Reserve Bank, their Wealth Effect Zimbabwe edition, their Weimar Republic edition, their Venezuela edition. This is what we are playing now. I saw this news story on Thursday, November 12th, from Yahoo Money. Dara Singh, the number of 401k and IRA millionaires reaches record high amid the pandemic, from Yahoo Money. The number of retirement investors with at least 1 million saved in their Fidelity investment accounts hit a record high in the third quarter, even as the pandemic's second wave approached and the economic outlook remained uncertain. So this is not a fundamentally driven where everyone's making millions of dollars off the stock market. This is mostly the Federal Reserve, like I said, policy, from starting with the Alan Greenspan Fed, where they explicitly wrote tons of speeches, papers, op-eds, and then it carried over into the Ben Bernanke Fed and in the Janet Yellen Fed, promoting the wealth effect. Now, there's a number of different reasons why they did this. Daniel Emerman has talked about this in extensive articles. I'm not sure how many articles he writes. I spoke to him in emails. I think he's writing a book updating this, but it was official Fed policy they justified higher asset prices, higher nominal asset prices, and this is the problem: nominal returns versus real returns. So if they devalue the currencies with stagflate tax lie in currency, where if they devalue the value of the dollar, if your purchasing power goes down, $1 million is not $1 million from 10, 20, 30 years ago is not going to have the same purchasing power as $1 million today. So this is how messed up things are. The Fed's official wealth effect policy, it's meant for tax revenues, to get higher nominal asset prices for capital gains taxes on stocks, bonds, and real estate. Also, the justification the Fed meant for the wealth effect was so if people were making money off stocks and bonds and real estate, they would spend more as consumers. For some people, maybe for the hedge fund managers out there, they could go and buy rent an extra sugar baby and then go and take her shopping, her girlfriend shopping or something like that, and go or buy an extra Lamborghini or go or buy a third or fourth house. Maybe Bernie Sanders, they get in a bidding war with Bernie Sanders to go and buy a third or fourth vacation home. Notice how Bernie only wants to go after billionaires now. He doesn't want to go after the people worth around $10 million because Bernie Sanders is worth around $10 million. So the Fed's official policy, the wealth effect, it's been going on for decades now. Jerome Powell did attempt to slow down this wealth effect. He attempted to raise interest rates, but the damage had already been done. I think he raised interest rates maybe for about a year. There was an attempt to raise interest rates a couple times. I think maybe 5 or 6 times, like a number of quarter point hikes, and he almost collapsed the entire system in Christmas 2018. Why? Because every time the other Fed chairman lowered the interest rates, Wall Street, the large banks, the hedge funds, the large corporations, they increased leverage. They borrowed more, making the system more and more and more unstable. And that's why this credit Ponzi scheme, because there's too much debt that mathematically cannot be paid back now. That's the problem. We have a cash flow problem, and we have way too much debt, and Wall Street is still selling more debt because the bond prices are artificially high and interest rates are artificially low, and people are betting on capital gains on bonds instead of income because the central banks and governments have eliminated all the pretty much eliminated all the safe forms of income. Or they're going to start, the ones they haven't eliminated yet, they're going to start taxing. Or they're going to freeze. If you're a rental property owner, look at the damage they've already done. What a mess. Okay, so let me read the rest of the article before I just get totally off tangent. The number of so-called 401k millionaires increased 17% to 262,000 from 224,000 in the second quarter, according to an analysis of more than 30 million retirement accounts at Fidelity, provided exclusively to Yahoo Money. So thank you for giving us this data. Now we can start talking about all the damage, all the distortions with the Cantillon effect that the Federal Reserve and the other central banks are doing. This is a perfect example. The real economy is in tatters. Politicians are talking about more lockdowns, especially are in the White House, and we'll see what happens with that. But there's not any fundamental justifications really for a lot of these higher asset prices. It is all central banks driving these things with bailouts, rules changes, and manipulations, and also stimulus checks. And we're not even at the crazy parts with crazy MMT and the other stuff that's probably coming in the not too distant, even more MMT in the not too distant future. Fidelity provided exclusively to Yahoo Money. The number of IRA, if you're not in the United States, an IRA is an individual retirement account, and a 401k is a retirement account for employees. So an individual retirement account normally is someone who switches jobs, and then you could set up your own individual retirement account. You get more options. Or you keep the money in there depending upon what type of retirement account, if it's a Roth or a regular IRA. The number of IRA millionaires also increased by 15% to 234,000 from 204,000 in the second quarter, making a 15% jump. And then I'll add in here, because the article is definitely not going to talk about it, thank you to the Federal Reserve and the other central banks for making this possible. The previous records for both were in the fourth quarter of 2019, when there was 233,000 401k millionaires and 208,000 IRA millionaires. And Jerome Powell did try to prick the bubble by raising the interest rates, and then he realized that it's impossible to raise interest rates in a Ponzi scheme because you can't taper a Ponzi scheme. So raising interest rates even a little bit, which the Fed is claiming, they're going to reduce their balance sheet meaningfully. They're going to start raising rates again, which is what some economists on Wall Street, mainstream economists and Keynesians, are actually talking about. The Fed's balance sheet is done growing. Oh, yeah, sure. Yeah, sure. There's only all that treasury debt that needs to be rolled over, all that toxic garbage, all those bonds that are going to blow up in the next 6, 12, 18, 24 months that Wall Street has sold, collected their commissions and bonuses on, and dumped onto pension funds and others. And then not counting the unfunded liabilities, the global pension fund shortfall, it's just a mess. The previous records, I already read that, so it's still going up. And this is what happened in other signs of monetary inflations in the past in other countries. Now, we're not at hyperinflation levels, because that's more of a psychological event, but these types of millionaires where people are literally doing very, very little and their retirement accounts just go up and up and up. Even the Democrats here in the Washington, D.C. metro area, and this was before the pandemic when I was going out to eat, and I would hear like really rich Democrats at restaurants at like cheaper places because they were saving money, and they would say, "I hate Trump." I would hear this all the time. They would say, like, just anecdotally, they would just be talking to themselves like how much they hate Trump, but how much they love their retirement accounts and how wealthy they're getting. Well, they're only nominally getting richer. Okay, their tax bills, their capital gains taxes are going up. Is their standard of living really increasing massively? Now, maybe if they're lobbyists or they're connected to the money trough there with the Cantillon effect, and they're able to offset stagflate, tax lie, all those other taxes, higher nominal asset prices. But for the majority of us Americans, higher nominal asset prices, first of all, a lot of Americans don't own massive amounts of assets, don't own a lot of stocks, don't own a lot of real estate, don't own a lot of bonds. Some people, their biggest investment, and it's not really an investment, is their home. So, A lot of people here in the Washington, D.C. metro area benefited from high nominal asset price inflation, but the reality for people on Main Street is they're not better off with higher asset prices because their bills are going up, they're getting killed with stagflate, tax lie, and shrinkflation, and it's just the higher asset prices is not doing what the Fed claimed with the wealth effect. Although I think the wealth effect, a lot of it was mostly for tax purposes. So the U.S. government, the U.S. Treasury, could steal more from nominal gains from stocks, bonds, and real estate taxes. Quote, there are a few things at play here, including basic market growth, said Emily Franco, financial advisor at Ford Pitt Capital Group. I doubt, like I said, they're going to mention the Federal Reserve Bank here increasing the balance sheet. Quote, when comparing the third quarter of 2019 to the third quarter of 2020, we've seen the stock market indexes reaching close to all-time highs. Let's see here. The Dow, is it back at 30? Okay, the Dow is almost to 30,000. Just wait till we get to 40,000 and 50,000 if they hand out checks and print out, and the real economy is not doing it, getting worse. When comparing the third quarter 2019 to the third quarter 2020, we've seen the stock market indexes reaching close to all-time highs, despite the bumpy ride we had this spring and summer. Yeah, the bumpy ride is there was the pandemic. The real economy is still in tatters. There's all these states going back into lockdown, but don't worry, the Fed will inflate all these asset prices, at least a nominal value, and the deflationists will not call this inflation because the majority of deflationists don't count asset price inflation as inflation. The increases occurred during July, August, and September when more than 14 million Americans filed for jobless claims, according to data by the Federal Reserve Bank of St. Louis. At the same time, so the Fed was mentioned in the article, just not how the Fed is intentionally inflating asset prices nominally since the Alan Greenspan Fed, and that's basically been Fed policy for decades. At the same time, the Standard & Poor's 500 index increased about 8.1%. Retirement accounts overall got a boost. For all retirement investors, their average account balances also increased. IRA balances rose 6% to $117,700 for the second quarter, from the second quarter's $115,000. This was a 7% uptick from a year ago at $110,200. So nominal value, they are moving everything up nominal value almost every year, a 6-7% boost almost every year. 401k balances had a slightly smaller increase, so you don't even have to put more money into the accounts. You just have to sit back and let it go up, and the Fed's going to make you all millionaires at one point or another. But ask the people in Zimbabwe, ask the people in Venezuela, ask the people, well, I doubt there's any survivors from the Weimar Republic hyperinflation who are still alive, but you can read about it in Adam Ferguson's When Money Dies. 401k balances had a slightly smaller increase, which is a great book, but he doesn't think the U.S. will have a hyperinflation. He thinks the U.S. is just going to have really horrible stagflation because the U.S. is the world reserve currency, and according to financial history, there has been no world reserve currency that's ever had a hyperinflation. So we'll see what happens. The average balance rose by 5% to $109,600 in the third quarter, up from $104,400 in the second quarter, up from 4% from a year ago. About 9 in 10 investors, and this is despite the real economy and Main Street, small and medium-sized businesses, mom-and-pop businesses being destroyed by politicians and bureaucrats and not getting bailout money. Absolutely horrible. These governors, these politicians, these bureaucrats, and they're destroying the real economy. And then, of course, they're blaming capitalism, and they're doubling and tripling down, or more, on the same stupid policies. About 9 in 10 investors also left their contribution rate to their retirement accounts unchanged. So you don't even have to put any money in, and your account still goes up. This is Fed magic. This is a fiat currency and credit magic. Nominal increases in asset values, asset price inflation, nominal values. And guess what? As long as the asset prices are going up, when you sell, the government gets to take higher and higher nominal gains that are probably not even offsetting the real inflation rate. Quote, it's encouraging to see average account balances increase slightly over the quarter and many individuals continuing to save in the face of the challenges posed by the pandemic. So there is actually a boost in savings rates. However, globally, and I've heard some Keynesians like David Rosenberg, I listened to that interview with Danielle DiMartino Booth that he did in the last month or so. It was an interesting interview, but now he claims because there actually is some savings and some Americans have paid down some credit card debt that there actually is a global savings glut. I mean, compared to all the debt outstanding, because some Americans have smartly paid down credit card debt, and some Americans have some savings and they didn't go blow all of their stimulus checks on, I don't know, a bunch of frivolous things. Now the Keynesians are back to saying, oh, there's your global savings glut. I mean, you have to look at the whole big picture here. Over 250 trillion in debt that cannot mathematically be paid back. And there's a small amount of savings now here in the U.S., and the Keynesians are saying it's a global savings glut. Some of the Keynesians. Quote, it's encouraging to see average account balances increase slightly over the quarter, and many individuals continuing to save in the face of the challenges posed by the pandemic, especially as many organizations, as well as their workers, are struggling in the current business environment, said Kevin Berry, president of Workplace Investing at Fidelity Investments. Many baby boomers over-allocated to stocks. The study also found that 38% of baby boomers were overinvested in stocks based on their age, but that kept them in position to reap the gains from the near stock market highs. About 1 in 12 baby boomers were 100% invested in stocks. That's a good gamble. That gamble so far has paid off. Now, if the stock market crashes again, that's like the ultimate buy the dip. What Christopher Cole said in his last interview there on Grant Williams' podcast. I highly recommend listening to that interview. He actually... that interview is pretty amazing. It's almost 2 hours long. It's like an hour, 40 minutes long. That was done last week. And he actually described a lot of the stuff for the large Wall Street banks, the money center banks, the large Wall Street investment banks, and the large hedge funds getting bailouts. He actually described a lot of the things. He didn't say it was the Cantillon effect, so I don't think he's an Austrian school economist, but he basically described the Cantillon effect. About a third of baby boomers did shift some of their savings into more conservative investments during the pandemic. And by conservative investments, they should be in some gold, buying the dips on gold, but I doubt they are. This study found those who are on the, or silver, or gold stocks, which are going to be increasing dividends and making a lot of money, even at this paper gold price correction here, with the gold price rallying a little below 1,900 at 1,894. Conservative. I'm guessing conservative maybe is bonds. I don't know if bonds are really conservative anymore, considering the valuations on bonds and all the schemes that are going on with bond sales from Wall Street. Those who are in the higher income end of the spectrum were more likely to invest a generous sum in stocks, Franco said. Quote, while of course this is much easier goal to attain while you are a high income individual, that does not mean unless Joe Biden's tax plan, Joe Biden's in the White House or Kamala Harris is in the White House and then their tax plan gets implemented, then you're pretty much screwed if you live in California, New York, New Jersey, Illinois, those states. That does not mean it is unattainable for some, especially in a major city in those states. For someone with a more modest income, I think 50 Cent said it's like 62%. It's like 62% all in on taxes. That's insane. And people here in the U.S. still, if you're paying 62% of your income and blaming capitalism, you don't understand the system at all. You need to start looking at politicians and bureaucrats and the central bankers. Franco said, quote, by maxing out your annual retirement contributions and staying invested even during market downturns, you increase your chances of having enough retirement assets left over to provide for both your own retirement and to pass on to future generations. Blah, 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 blah. That's the end of this article. And guess what? Not a single mention from creating all these millionaires and the retirement accounts going up like magic, 6% a year, 7% a year, without putting any more money or savings into the retirement accounts, the 401ks or the IRAs. Not a single mention here of Federal Reserve monetary policy. You know why? You mentioned that. If you're a mainstream financial analyst and you're risking, if you criticize the Fed publicly, you're risking getting blacklisted. You're risking losing clients. You're risking never getting a job again in the industry. If you criticize the Fed publicly and you work in the mainstream financial industry too harshly. And that's why you have people like Danielle DiMartino Booth, and she's doing that now after she left Wall Street. And after she retired from the Federal Reserve. And after she stopped writing for the mainstream financial media. So not a single mention in this article of all these new millionaires created in retirement accounts for stocks. Some people are 100% invested in stocks, probably bought the FANG stocks, probably index stocks. From talking to people, they went all in on indexes because that's what the financial advisors were pushing. Not a single mention of Federal Reserve monetary policy with the wealth effect, starting with the Alan Greenspan Fed, how the goal was to force asset prices higher at all costs. for a bunch of different reasons. And that's the truth of why the asset prices are hurt, because the Fed, one way or another, one manipulation or another, one distortion or another, one scheme, will figure out a way to manipulate those asset prices higher. This has been official policy now for decades. Heck, even in Japan, the Nikkei, Japan's major stock market index, even the Nikkei starting is finally, I think, out of its 30-year bear market. So I think even the Japanese stock market, due to central bank policy and intervention, is finally starting to go up. Tribune O Plebes. I love that. I love that name. He says, welcome to the new tax bracket. Bingo. There you go. Stagflate tax lie. Oh, your retirement account's up 15-20%? Oh, you're making more money on paper? How's your standard of living doing, buddy? Oh, your tax bill just went up 20-30% if you sell. Oh, those dividend taxes? Oh, your dividend taxes are up from like 19% to 44% under Joe Biden in the White House or Kamala Harris in the White House. Oh, all that dividend income you were relying on, now the government's clawing it back? I'm shocked. Charles asks, did I mention the China bubble about to burst too? Charles, there are so many bubbles. It's tough to keep track of them all. All these central banks, all these governments, they're all creating their currency units out of thin air to buy government bonds, to manipulate asset prices higher. All that's left until the real economy is back to somewhat normal levels, and maybe it looks like the people in power. Justin Trudeau just did an interview on Canadian TV saying this crisis is an opportunity, the pandemic is an opportunity for us to remake the entire global economy, to do this great reset. So never let a crisis go to waste. Never let a good crisis go to waste. All that's left, though, for these central planners, the politicians, the bureaucrats, the central bankers, with stagflate tax lie is rules changes, manipulations, and bailouts. That's it. There's no cash. There's very little cash flow left to service that debt. The debt's not getting paid off. There was no cash flow before the pandemic to pay off that much debt. The amount of total debt in the Ponzi scheme actually doubled in the last 10 or 12 years. And the amount of credit in China was the main increase. China and the emerging markets went crazy with the amount of debt and credit over the last 10 or 12 years. So the US was already going crazy, but China didn't have that much debt, that much credit and debt in their economy. The last 10 or 12 years, that has changed a lot. It's tough to keep track of all the bubbles. There's so many. JB says he thought it was Halloween music. No, it was the original intro for Who Wants to Be a Millionaire. So I thought it was appropriate. Considering now they're making a lot more people, now the Federal Reserve Bank and the other central banks, because there's a lot of currency through the Cantillon effect in other countries that ends up laundered here into U.S. asset markets, especially U.S. real estate, but also general U.S. stocks. That ends up here. So all this, the central bankers are making more and more people millionaires, nominally at least. But again, this goes back to, is your standard of living improving? Has your standard of living improved over the last 10, 20, 30 years? Or is your cost of living actually going up? Is your purchasing power being slowly or quickly, depending upon where you live, certain countries are worse than others, destroyed? Purchasing power of the currency. Because if you're an emerging market currency, since February, there's a lot of emerging market currencies down enormously against the dollar. Dollar index right now is at 92.57, but there's a good amount of emerging market currencies that are down 20% or more against the dollar. So if you live in one of those places, your imports are going to be expensive, a lot more expensive than normal. Okay, Parabuilding says the intro was funny to get in on the timing. Well done. Okay, thank you. I appreciate it. I'm trying to keep things a little humorous here. Because again, not everyone's benefiting. Most people are probably not benefiting from their retirement accounts becoming millionaires. But even the people who are millionaires, they don't realize it. They're going to be paying a lot higher taxes. And their standard of living is going to be probably destroyed too. The majority of people don't realize it, though. My parents don't realize it. I've tried explaining this to them, nominal returns versus real returns, the real inflation rate, how they need to grow their income. They don't want to hear this. That's why they don't own gold. That's why they don't own silver. That's why they don't own gold stocks. That's why they didn't buy rental properties before the pandemic for many years when they were looking for income. I tried to lecture them on this. I don't think, unfortunately with the CDC rules and all the legal nightmare, I don't think rental properties are going to be good for a while. At least in the United States. There's way too much uncertainty and a legal mess. Maybe that will change. We'll see. Okay. Good super chat here. $10, JB Well. Thank you for the $10 super chat. He is also one of over 1,000 monthly Patreon account contributors. So thank you very much for chipping in, because I'm probably going to make $2 or $3 in Google AdWords revenues off this YouTube video. So thank you very much for allowing me to keep doing this and pay the bills. I appreciate it, JB. He says, what's your opinion on Stimulus 2.0 now that we have a divided government back in lockdown in Seattle? So I think we'll see what happens with the 2 Senate runoff seats. The Democrats are going to spend an insane amount of money trying to buy those seats in Georgia. So we'll see what happens with that. But as of now, I mean, there's still pretty good odds that Trump can win in the courts. So I don't know if it's 50%, but there's good odds. I've spoken off the record with one of Trump's attorneys, and they think they have a good chance, but it's an uphill battle. It really depends on which judges that they can get, so we'll see. But if Joe Biden or Kamala Harris is in the White House, look, at this point, JB, even with gridlock and a divided government and Republicans having, or it's either even in the Senate or slight, I think we're at the point now where we're going to have the presidents just doing, and this has been getting worse and worse for decades, but now it's just going to get even worse. We're going to have a lot of executive orders. So I could see Joe Biden or Kamala Harris attempting a lot of executive orders for MMT stimulus checks. I mean, Jerome Powell or whoever replaces Jerome Powell as Fed chairman has said that they are more than willing to lend Congress the money so they can spend it. So I think the bailouts and the checks are going to get done. If the Democrats gain a slight majority of both houses, the states are going to get bailed out and more money is going to get printed. But what most people are not talking about are all the financial assets the Fed is going to have to buy. There is a lot of Treasury debt that is short-term that is going to have to be rolled over, or the Fed's going to have to directly monetize. The large banks are buying a good amount of the Treasury debt right now. Here in the U.S., they can't buy it all. And there's no appetite right now outside of the United States for foreigners for net purchases of treasuries. And I think the pension funds are about super saturated on a lot of treasuries too. So really, it's just going to be for purchasing U.S. treasuries. It's going to be mostly, I think, the large banks here and the Fed. And that's it. So there's a lot of that total amount, over $27 trillion in total debt, that's short term. That's going to have to be rolled over. And that's not even counting all the other financial assets, the stuff that's going to go bad. So the Fed, this is why we really need another Fed audit, because with the rules changes that the Fed was given in February and March by the Treasury, in theory now the Fed could just create as many off-balance sheet special purpose vehicles as they want. They may be doing that already. There's no way to prove it that they are or are not. And actually, what just came out in the last week is the Fed's financial stability report. It's 80 pages. So I haven't read it yet. I've read a few summaries, but I do want to dive through those 80 or so pages and see if I can find any nuggets in there for patrons in the coming weeks. So it's 80 pages long. And some of the summary articles I've read, there's some admissions in there that things were much, much worse in February and March, that the system actually collapsed much worse than even 2008 and 2009. And things were really, really bad in 2008, 2009. So if things were really that bad in February and March, and the Fed's balance sheet only went up slightly, I suspect the Fed is playing even more games to keep the system going. Like that there's more swap lines they're not counting. There's all these off-balance sheet stuff that the Fed is doing, bailouts that the Fed is not counting. I mean, there's so many tricks. The U.S. federal government has tons of off-balance sheet spending each year, trillions. That's not accounted for in the national debt. There's trillions of dollars a year in off-balance sheet from the Pentagon, from defense spending. There's trillions and trillions. That's how of a mess it is. So thank you for the super chat. I appreciate it. One more super chat here. Thank you for the $4.99 super chat, J6. I appreciate it. He says, will hyperspending ever affect treasuries? Not if the Fed is committed to another QE infinity and yield curve control. So you're looking at Japanification and the Fed then. So you have these people like Dr. Mark Faber and others predicting big interest rate spikes. And that would be if the Fed was not intervening. What if the Fed officially announces policy of yield curve control? One of the guests on Grant Williams' podcast in the last couple months, he said basically that yield curve control is the Fed announcing a separate and new QE infinity program. So the Fed then would buy as many of treasuries on whatever part of the curve it takes to manipulate interest rates down. So basically then the Fed would try to crowd out all the people out of the market and stop that from interest rates spiking. Now the Fed hasn't officially announced yield curve control yet, but a lot of people think we're heading there soon. We've had a little spike in the 10-year U.S. Treasury and the 30-year. So we've had little spikes in it. But, most people don't think the spikes are going to go too much higher. If the Fed is really committed to Japanification, yield curve control, Ben Bernanke was talking in 2016 for policy recommendations for the Bank of Japan, because Japan's been doing this longer than everyone else. Now you have every country trying to do it. I'll do another separate show on New Zealand Central Bank. New Zealand Central Bank has now bought, I think, 37% of all their government debt. So you've had, in just the last 5 or 6 months, you've had New Zealand's central bank create enormous amounts of currency units out of thin air to buy up an insane amount of their government debt, so the size of their government can stay the same at all levels or increase. So you have all these governments doing very, very similar policies and then telling us they're fighting deflation and it's not inflationary with the fake consumer price indexes. But all those currency units, there's going to be leaks. There's going to be distortions, especially in currency exchange rates. Clearly, it's in a currency war. You're not here. What's surprising is Jim Rickards wrote the book Currency Wars, and he's not talking about currency wars. That's what surprises me. Because clearly you can see that all these central bankers, whether they're running a dollar peg or not, I've been covering this now for weeks. These central bankers people are leaking information to Reuters journalists and others, are creating their own local currency units out of thin air to buy up government bonds, to maintain the size of government or increase the size of government, and to devalue their own currency against the dollar. The problem, and this is why exchange rates aren't going absolutely crazy, is the currency markets are trying to figure out who's printing more, and you have all these governments trying to do the same thing. It is a mess. So I answered your question. I went a little off tangent, but it really depends if the Fed is fully committed to yield curve control. If the Fed goes full yield curve control, full Japanification, they're going to crowd out a lot of the private sector bond traders. And anyway, those treasuries are used as collateral for what Jeffrey Snyder has talked about in all those. Those treasuries are used as collateral for a bunch of things. It's not just in the euro-dollar market. Those treasuries are used as collateral for a bunch of crazy casino trades. So are the reserves that the large banks are given by the Fed. And then if the large banks get in trouble and they blow their reserves at the casino, or they have enormous losses that drain their reserves, the Fed the Fed just gives them more reserves, more casino chips. That's the best way to think of it. And this is why the fiat currency and credit scheme, this is why a fiat currency system is so dangerous, and the fiat currency and credit is a Ponzi scheme. Luke says, take your chips out of their hands, hold gold and Bitcoin and silver. Yep, you can be your own central banker and you could hold your own reserves out of the system. Your savings then are not in dollars, euros, yen, Chinese yuan. Yep, that's smart because long term, these currencies, the value of these currencies are going to buy you less and less and less and less and less. And the government economic data is not going to cover, is not going to be accurate about that. James says life has become a combination of The Matrix and The Truman Show. Yeah, I would agree with a lot of that. There's a couple other movies that are rated R and NC-17 and XXX that I wouldn't. And well, not safe for work. Let's just say that I would mix in there too. That's how immoral and distorted and a lot of signs of the Roman Empire. Let's just put it that way. And it's the fiat currency. It's fiat currency. It's people's standard of living being destroyed by politicians, bureaucrats, central bankers. The currency's being destroyed. People can't pay their bills. And then that causes desperation. People have no morals, no ethics, and they're willing to do almost anything to survive or anything to survive. And that's about where we are in many places. It wasn't always that way here in the United States, but now it's becoming that way, especially in major cities and metro areas where it is very expensive to live. Okay, well, I think that's it for this short live stream show. So hopefully I interjected a little bit of humor into all this, but the Fed basically has all of us playing Who Wants to Be a Millionaire with the Wealth Effect, Zimbabwe, or Venezuela, or Weimar Republic Edition. And these people in the article here didn't even have to put any more savings into their retirement accounts, and it magically, over the last couple years, just went up 6%, 7%. But some of them have enormous exposure to the stock market, and a crash is going to be bad for them. Although, I think at this point, how long would the Fed even allow a crash without more rules changes, more bailouts, more manipulations, and then getting the stock market back up and really trying to destroy the currency. So if the stock market does crash again, we might only have it down for 8 weeks or so, like what happened from February 19th to the first week of April. So there might be a buying window there, but at this point, who knows? Because it's really in the incentive of the central bankers, the politicians, and the bureaucrats for higher nominal real estate prices, higher nominal bond prices, and higher nominal stock prices. And even Japan now is out of their 30-year stock bear market. Lynn Alden was posting a chart about this. Japan's stock market index is finally out of the bear market. So it only took 30 years, and they were doing Japanification longer than anyone. But now you have literally a lot of the developed countries where they're devaluing their currency and creating artificial bull markets in stocks. Okay, everyone, bye for now. Oh, and don't forget to check out my Patreon. It is only $5 a month. And there is a lot of content, research, analysis, and financial education behind the paywall there. There's almost 150 unique articles and audio podcasts and technical analysis charts on a lot of different topics. And I think it's well worth the money. And most importantly, it's going to help me pay my bills and keep this content going because YouTube's going to make it almost impossible for me to make any money at this. I think I'm probably going to get like $2 or $3 in ads off this. So thank you very much for the super chats. I made more money than I am going to make off ad revenues. Thank you very much for the super chats. Everyone have a nice week.